So as we've been even saying, the functions of Treasury as relating to Treasury risk management is basically how to identify, to measure, to quantify, to monitor, but also not only that, but also how to measure those risks and to put in place proper risk management and also risk mitigation frameworks and strategies to be able to hedge and mitigate our organizations, our banks, our central banks, our reserve banks against such treasury risks. And we've seen the different types of treasury risks. So first, any treasury department, what they need to do is first identify this risk and classify them. For example, we can identify the different types of risks that are likely to face our bank or our books, our portfolio. For example, you can look. We looked at. We've been looking at hypothetical portfolios of banks and businesses and disclosures of some hypothetical, let's say, National Bank of Malawi, JP Morgan Chase, and also KCB Bank. We looked actually at the actual latest audited financial statements of unaudited. They were unaudited financial statements of KCB Bank and Liquidity Bank. So from each item of that, those balance sheets in the releases, then we can be able to identify what kind of risk faces such the treasury department of such banks. For example, as we know, interest rate risks, treasury risk, liquidity risk, credit risk. For example, credit risk and default risk relating to, for example, the size of their loan portfolio and the size of their provisions for bad and doubtful debts, market risk, things like that. And then so now we also earlier looked at how the treasury department of any bank can now measure such a risk or impose sanctions or requirements onto banks to measure such risks. And then after measuring such risks, then they will know their impact on their books, for example, on the net interest income, that is NII. So, for example, we at in the morning how we can do a simple, for example, VAR, portfolio VAR at a particular confidence levels compounded by the value at risk or our long position in, for example, in a security, or if it is a loan in our loan book, compounded by some particular Z score. Okay.
Yeah.
Yes. So that particular portfolio VAR or portfolio value at risk then will be able to inform how it will impact our asset and liabilities mix and hence our liquidity mix or liquidity management strategies. But also not only that, the central bank or the Reserve Bank of Malawi can now impose restriction or impose requirements onto the commercial banks in Malawi to be able to monitor such risk. For example, monitoring and forecasting for example, the past. You see, the past volatilities and the past risks inform even how we calculate the portfolio of our right.
Yeah.
So how they monitor, how they report on such, they should be able to disclose their different types of risk and how it affects them and to monitor them to inform, for example, it will even inform their stress testing because basically VAR is stress testing. Okay. So and then that therefore that comes to our next point during the treasury risk management framework, that is stress testing. They should be able to put in place um, adequate and effective stress testing mechanisms to be able to test whether their banks and whether their ALM strategies are able to withstand any worst case scenario in market conditions such as market crashes, sudden withdrawals, and favorable like credit risks, and also even varying the risks or varying their assets, as we just saw when the assets of the National Bank of Malawi rose by 2 billion from 10 billion to 12 billion. And then so now finally there are the backstops that now what strategies do they put in place to hedge themselves against or mitigate themselves against such risks. So we saw all about the different hedging strategies that we talk, for example, diversification and also use of the derivatives such as option swaps, futures, and the other contracts, and also option swaps, futures, and forwards, and also by generally diversifying our not only our risk profiles, or for example where we invest, but also even diversifying our funding sources, basically diversifying our book. Okay, not concentrating it on too much or on any one particular source of funding. To make sure that basically it's also one of the requirements of the Basel three framework relating to the LCR, that is the liquidity coverage ratio, and also the NSFR, that is the net stable funding ratio. Okay, so now how does the government structure of a treasury department now enforce such liquidity and also treasury risk management frameworks and strategies? So as you just said, there are some oversight roles, for example, bank oversight, risk oversight. Within bank oversight roles of the Treasury Department, for example, there are RBM. There can be also the risk oversight department. So they can, RBM, for example, the Reserve Bank of Malawi can establish something called a risk committee that especially looks at all commercial banks' back responses and their risk monitoring and also their risk mitigation strategies and frameworks that they have put in place, and to ensure that they comply with such not only liquidity measures but also risk management measures. Okay.
Okay, so now there,
Mhm.
okay, yeah, I don't know how
They can create a department.
okay,
For
what does
example, just
happen?
just just a department dedicated on bank risk oversight as part of the bank oversight
Yeah, we have that one.
or bank supervision department of
Yeah,
the
and
of
we
the
have
RBM.
what they call RESU for the supervision.
Risk
Yeah,
risk exposure.
yeah, for the supervision
Oh,
part.
okay, okay.
Then, okay,
Risk exposure supervision unit. I think that's it.
yeah,
And for the
something like that.
mhm.
Okay, yeah, now the other one is ALM for the
Exactly,
bank itself. Right now, coordination.
exactly. Just as I said, they can set up a risk department that is specifically focused on the ALM or the ALM mix and management frameworks of the commercial banks and looking at their releases and their reports and their disclosures. Mhm.
Yeah, okay, but now in this scenario,
Mhm.
it's the race who I think that does that.
Oh,
So,
okay,
yeah, because when I go back, I
okay,
need to get more
okay,
details. Yeah.
okay. But these days there are even advanced softwares and management systems that even the treasury or the bank oversight or bank supervision department or the RBM can use. Some management software they are called treasury management software. I'm aware of some.
Okay.
We use some ourselves for the treasury. It just, for example, the real time monitoring of the risk exposure of banks and their laid down procedures for mitigation. And then we have talked about risk mitigation, right? Yeah. How no stress testing, then risk mitigation. You first do stress testing, then now you do risk mitigation.
Yeah.
You put in place frameworks to ensure that your company has enough capital buffers to withstand or to absorb such losses or such risks, and also to even to be able to meet your short-term obligations, especially during market distress and economic economic downtimes. So let's just go as part of the third sub-module. Let's look at some of the key treasury risks. Okay, and see the third module.
Okay.
Some of the key treasury risks, liquidity risk, market risks, and also operational risk. So, liquidity risk. Liquidity risk is basically the risk that you won't be able to have enough liquidity or you won't be able to have enough cash and cash reserves to be able to meet your short-term obligations and other even obligations as they fall due or within the time they fall due. Okay, let's say we have explained about this a lot. Let's say a bank is facing a surge in withdrawals, or their a loan that they borrowed on overnight lending or on short-term interbank lending is falling due. If they don't, if they face liquidity risk, that such that they don't have enough capital buffers that can absorb or can be able to cater for such short-term risks, then that bank is facing liquidity risk and must put the treasury department must be put to task to ensure that they can put in place effective mitigation tools to curb those risks. And liquidity risk, what are some of the causes? Can be caused even by market downtimes, a surge in withdrawals, or even like a bank is not maintaining a good proportion of HQLA, that is high quality liquid assets. Yeah, a bank is, for example, relying on debt, like the bank we saw Northern Rock and the other one in Malawi. So a bank is usually required by even the CBK or the RBM in this case to be maintaining a proper fraction or a proper proportion of their capital buffers in form of cash and cash equivalents that can be able to meet unexpected withdrawals and also other market disruptions and market shocks and bank runs, things like that. So therefore, just that is just exactly it. What the Treasury Department can now do, they must make sure that they put in place, they increase their HQLA. They are holding on high quality liquid assets, for example, in T bills and T bills, and also cash and cash. They can drive deposits and promotions to drive in more cash, but they can also, if they were compliant, they can also be able to access the CBK's uh, credit lines and emergency credit lines, and also some of the other CBK facilities or RBM facilities at their disposal, such as discount windows and ECLs. Also, they need to ensure, the Treasury Department needs to ensure that going forward now, okay, they closely monitor their ratios, their liquidity ratios, that are the LCR, the liquidity coverage ratio, and the NSFR, that is the stable funding ratio. The second one was market risk. Market risk is basically like a risk arising from market variables, things like, let's say, inflation or forex rates or exchange rates, like the risk relating to changes in the, for example, market variables and market factors. Okay, for example, if there is an interest rate risk, an increase in the interest rate, therefore even the value of the bank's holdings in both assets and the liabilities, which they are basically their ALM framework and mix will change, right? If they had assets in liabilities or loans worth 10 billion, and interest rates in the market due to market risk changes or hikes, no, reduces, I want to drive the point home, reduces to, let's say it was 10, they lent at 10, but now it reduces it to 8. Therefore, if they are 10 billion, then now in the real value of their loans assets will now be 8 million, right?
Yeah.
Exactly. Also, forex risk. If you hold too much forex reserves and the currency fluctuations or currency risk, what we call forex risk, does not favor you, then the nominal value of your holdings in the foreign currency denomination, in terms of, for example, your USD denominated assets like loans, okay, that you have given out, or you are, let's say you hold some T bills in foreign currency, then those also reduce. So all those are forms of market risk. And also, let's say even commodity risk. For example, some of the derivatives and commodities in the commodities market, there's also market risk if their prices changes, right?
Yeah.
Yeah. So market risk is basically when the prices at the market prices, there are fluctuations in it. And then so now, what can now the Treasury Department of, let's say, the National Bank of Malawi in this case do? They, in that case, I just in the derivatives market, I just alluded to it. They can use the derivatives hedging options, option swaps, futures and contracts, and other contracts to hedge themselves, and also they can they can try to even do the risk mitigation that we talked about, for example, rebalancing and also diversification of their funding sources, or investment holdings. Another one is now credit risk. Credit risk is where the company is now unable to pay its obligations. For example, or even an individual is unable to pay.
It's like what the counterpart is.
Exactly, exactly. So they can even use swaps in that case, or they can only lend to those with good credit ratings or creditworthiness. CWA, creditworthiness assessments before lending, or even if they are lending to in the interbank lending, okay, interbank market lending, okay, they can only lend to banks that they have conducted creditworthiness assessments, and also they can hedge themselves using swaps. They can use currency swaps, things like that, or credit default swaps. And then the last one is operational risk. Operational risk, basically, I talked about it. You remember?
Yeah.
Human error. Basically, operational risk is human error. You as a manager in the treasury department, you are doing some risk assessments based on your own, for example, confidence levels, or you are hedging your speculation whether to go long or short, and then that leads to errors, and then so now that can lead to operational risk. Okay, especially when in that case, the people at JP Morgan Chase decided to go long, but then expecting that the euros and the other currencies were to strengthen against the USD, but the USD ended up strengthening.
Yeah.
So that was an example of where both, all these risks can also even impact the same balance sheet all at the same time, right?
Yeah.
So in that case, it was an operational risk, but also a forex risk.
Yeah.
Then so now let's see how, for example, the treasury, these these types of risk, these, for example, market risk, credit risk, and also operational risk can be reported, for example, or can be the metrics for measuring them. Basically, how do we measure them? One, let's start. All these we are just brushing them over because we talked about them. For example, liquidity risks is measured by the liquidity ratios, right? For example, the LCR and the NSFR, right? Also, even cash flow coverage ratios, they are also that can measure the liquidity risk. Mm. Remember when we were, for example, projecting cash flows?
Yes.
Okay, that's basically what LCR is, right?
Yeah.
The HQLA over the what you project to be the net cash flows over a period of time. Let's say a 30-day period. Market risk, we said it can be measured by VAR. Okay, and also credit risk, we can, for example, by the for example, the provision. Okay, credit risk, right? Remember credit risk, that's where we can even use things like the we calculate the value of, for example, our non-performing loans.
Yeah.
Okay, and then so now,
NPL. Yeah.
exactly, NPL, and then so now we can even calculate the risk. We just did one where we calculate the credit risk rose from 2% to 7%, and then therefore we were able to calculate. So those are some of the metrics or KPIs, or how to quantify such treasury risks. And then so now these need to be reported, or this needs
So
to be
the
disclosed.
operational one can still be, is it VAR?
Hmm. Oh, by the way, I've forgotten about that.
The human error.
Exactly. Even the value. Exactly, VAR. Yeah, VAR can also indicate the human error. In that, exactly that we talked about in the last one.
Yeah.
Mhm. Where they were able to, they were speculating that the USD would depreciate, but it did, and then we were able to get at a confidence level what the VAR was. Yeah. So let's say you are heading a treasury, how to implement a treasury risk management or mitigation culture in your treasury department. How would you? In fact, this was your question, right? In the treasury department, how would you ensure that they put down appropriate risk mitigation, for example, in their risk management function. Okay. One, we said you can set up a dedicated unit responsible for monitoring the different types of treasury risk that we just talked about. You can continuously train your staff and also educate them on the. But also there needs to be collaboration between the different departments of, for example, the central bank, treasury, and also the central bank, or in this case the Reserve Bank of Malawi, and the commercial bank. There needs to be coordination so that there is appropriate oversight and monitoring and also bank supervision.